I'm Dava Behrens with Coldwell Banker Valley Brokers in Corvallis, Oregon. I've been helping people buy and sell real estate in the Mid-Willamette Valley for over 20 years. Here's some information you might find useful. I have Brent Norlander here with me today. He put out an email yesterday talking about what interest rates are doing, so I thought I'd invite him over and we could talk about it. So what's going on with interest rates, Brent?
Yeah, thanks, Dava. What we're really seeing right now is a big rush in wanting to know what is going on. Rates are up, rates are down. What is causing this? We're hearing different things. The stock markets are moving, the bond markets, the federal prime rate. And these are all kind of questions people have, and how are they all tied together? So really what we're looking at is the bond market is the best indicator for what mortgage rates are going to do. The mortgage rates themselves are not tied to anything directly. That's a misconception that people have. The federal prime rate goes up or the Fed's increase. That doesn't necessarily translate into mortgage rate changes. However, it does change markets and it has a trickle effect or a ripple effect down through the system. Mortgage-backed securities are what mortgage rates are based on. They closely mirror the 10-year Treasury note, and that is what almost all of the lenders or the forecasters use for a gauge. The reason being 30-year mortgages are the standard, and what happens is most of those are paid off in 10 years, statistically speaking. So 10-year money, 10-year Treasury note, very similar. They follow the same kind of margins, and that is used for a gauge. So when you see the federal prime rate go up or the feds raise the rates or lower them, they are doing that strictly to impact the economy. Slow it up, speed it down, is that right? Whatever. But the idea is that they're trying to keep inflation in check. That will trickle into free money on the markets. It changes the investor's opinion, stock market versus bond market. So an easy way to look at that, when the stock market's doing very poorly, what happens? People want to protect their money. They're losing it. So they go what they call a flight to security, which is buying bonds. And when they buy treasury bonds, those are guaranteed returns, lower percent returns, but they're guaranteed. It's a safe place to put your money. That's what happens in what we're seeing right now, volatile markets. When people put their money into the bond markets, it lowers the need to give them a higher interest rate because there's a lot of demand. So that lowers the yield on the 10-year Treasury note. That, not directly but indirectly, is mirroring what mortgage rates are going to do. So whatever the bond yield is, you can kind of anticipate that's what markets are going to do as far as mortgage rates are concerned. So
let me ask you, if bonds are up, rates are?
If the bond yield is up, rates are going to go up, almost always.
And if yields go down, it's a good guess that rates will go down.
Correct, and that's what we have seen in the last couple of weeks, where the mortgage interest rates have gone down 0.5 to 0.75%, and that is because the yield on the 10-year Treasury bond, instead of paying out 3.25% for investors, it's now down to like 2.8%.
So, but it was up, and rates responded by going up, and so now we're back down. We're probably closer to a level where we were last summer?
We are right now exactly where we were last January.
Okay, so not a huge change in rates over the last 12 months.
Right.
Fluctuations,
right,
but not a big change.
They came up over the summer, held up, and actually came up quite a bit in the fall. Again, worldwide turmoil causes the markets to do things, and then now it's kind of settled down. The stock market is doing poorly right now, and consequently all the rates have dropped down. They're all tied together with cost of money, overnight bank money, but that mortgage-backed security profitability, and consequently what all the lenders are going to price at is going to be an adjuster over that bond market is the easiest way to correlate.
So without having a crystal ball, what's your long-term projection on interest rates, say 3 months, 6 months, maybe 12 months? Do you have anything in your mind? What are the prognosticators telling us?
I've looked at several different economic forecasts and analysts on these, and what we've seen is they're anticipating the rates to be down where they're at right now. Probably not go a whole lot lower, but hover in the area that we're at now, which is in a 30-year fix for most people would be in the mid-4s.
Pretty good rates.
For an interest rate.
Historically speaking.
Historically, they're fantastic rates.
Yes, excellent.
And probably in the next 3 to 4 months, around March or April, they anticipate it starting to climb again.
Climb significantly, climb gradually, climb a lot, a little?
It should be gradual, based again on the forecasts, with the idea we'll be up in the low to mid-5s by the end of next year.
Okay, so low to mid-5s is about 1.5% higher than where we are now. What does that do to a buyer's buying power?
For that particular example, let's say the rates went up 1.5%. If you look at an average home cost, let's say $300,000, that would be, if the rates are 1.5% higher, your mortgage payment on that home is going to be the equivalent of $30,000 in value. So
price.
In price. So in other words, or a loan amount. So in other words,
a loan amount, sure.
So in other words, if you purchased a home for $300,000 in 8 months when the rates are up 1.5%, that would be the equivalent of buying a home with the current rates that we have now for probably $320,000, $330,000.
So acting now, if you can find something that's suitable, is probably in your best interest.
Correct. And what most people focus in on the price of the home, but you have to look at the picture of the interest rates in conjunction with it.
Yeah,
and what is that going to do? Not just what are the prices of the home going to do, but what are the interest rates going to do? And there's no way to tell for sure what's going to happen.
No.
But if you balance out the historical trends and what the forecasters are saying, I don't know what a price is supposed to do on homes this
They're
next
supposed
year.
to continue to increase in a more typical 3 to 5% annual appreciation, probably not the double digits that we've been looking at for the last several years. So interest rates are going to are supposed to affect the amount of appreciation, because that affordability factor makes a difference in the volume of buyers in the marketplace and what they can afford to buy.
Yeah, and if you want to put it in more simple terms, everybody wants to know, it's like, well, should I buy now or should I wait? Prices may go down, they may go up, rates. If you look at just the rate and the prices, right now you could buy something and you would probably come out in much better shape than you will, say, 12 months from now, statistically speaking, and from what the forecast models are saying.
Sure. Provided you can find something that's suitable and meets your needs. You just don't go buy anything because you can afford it. So anyway, that's really good information, and totally appreciate you coming and hanging out with us today.
Absolutely.
Yeah.